welcome to Investors Hangout. Historically, many investors choose dividend plans over the growth options to get their regular income. Are we suggesting that we should ditch dividend plans? Well, this is what we will be discussing with the CEO of Value Research, Dhirendra Kumar. Dhirendra, welcome.
Thank you.
This program is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Dividend plans are quite popular among investors who want to seek regular income, as I said. And I've heard many times people saying that one should ideally avoid buying the dividend plans. Why is it so?
Yeah, because there is a history to it. When you get dividend from a company, it is an evidence that dividend follow a lot of other things, which is a company sells something, incurs some cost, makes some profit, pays taxes, pays interest before that, then whatever be the profit, pays taxes on that. The residual money, whatever left in the company, after doing all this series of activity as a result of many people working all through the year, getting up in the morning, running their factory, running their banks, running their services, whatever, then it's a result of all this activity. After that, whatever money is left in the company, a part of it is retained by the company and a part of it is given back to the investors. That is the dividend. So when you got dividend from a company, it was a certificate of a performance that company is doing well after keeping the money, essential money for it to grow itself or to manage its affairs. It has been able to reward me with this much. So it was almost a certificate of performance. That thing got extended to mutual fund. In case of mutual fund, it never made sense, because in case of mutual fund, you can buy the stock, you can buy it at NAV, sell it at NAV. When you got the dividend amount was arithmetically subtracted from the NAV. So assuming that your fund has grown from 10 rupees to 20 rupees and the fund decides to pay you a 10% dividend. So, and decides to pay you 10% dividend today. So till yesterday its NAV was 20 rupee. Today it gave you a 1 rupee check and the NAV immediately becomes 19 rupees. So yesterday you could have taken 20 rupee back. Today you have got 1 rupee check and you can now take only 19 rupee back. It adds up to the same amount. It is your own money which you are getting it. So that is one. It was not a problem till January 2018 because there was no tax implication on that. What dividend from equity funds was completely tax free. Gains from equity was completely tax free if held for over 1 year. So there was still a small case for a short term return on your investment if it came before 1 year of investing. The return came in the form of, it was not necessarily a return, but it came in the form of a tax free inflow to you. No longer. Now there is a 10% dividend distribution tax even on the dividend paid on equity funds. So when a fund gives you a 1 rupee dividend, then you get only 90 paisa and 10 paisa goes by way of taxes. So there is a tax incidence to it. In case of equity fund and equity oriented fund meaning funds which invest over 65% in equity, it's a long term investment. You don't invest in equity to derive periodic, regular, small income from those investments. So you should not look forward to regular income, and it is no certificate of performance of an equity fund. But for historical reason, for convention, for tradition, people still have this perception that they get the dividend checks, my investment is doing well.
Kuch paisa aaya hai.
We feel happy when we get the dividend remittance and credited to our bank account, or earlier people used to get the dividend check in the mail. It may not be true in case of mutual fund. You can invest, you buy funds at NAV, you buy it at 20 rupee today, and tomorrow the fund company decides to pay you a 10% dividend. So you invested 20 rupee and the residual worth of your investment after the 1 rupee dividend will become 19 rupee. So you did not invest to take your money back. So in case of equity fund, it also amounts to getting your money back, which may not be the expectation. I think the only way to evaluate a performing investment is how it is doing in relation to the market, doing in relation to other funds of similar kind, and that's it.
Okay, so this is not an additional income you're
getting.
Not at all. So please keep this in mind. This is not an additional income that you're getting in case of mutual funds. So then my next question would be, what is the harm in opting for a dividend plan, even if it means periodically withdrawing your own money? Are we not doing that on the SWP?
SWP, no, it amounts to the same thing, but the technicality is different. The tax treatment is different. When you implement or when you decide to have a standing instruction of periodic withdrawal of your investment, what happens is you get a part of your investment. You get the part of your investment in terms of units. The gain on those investment is very small, and the treatment of, so effectively you have return coming to you in the form of a dividend or return coming to you in the form of a capital gain. Capital gain is more tax efficient because you are liable for capital gains after indexation, which is adjusting your gains for the inflation, and then you pay 20% tax as compared to 29% dividend distribution tax in case of a fixed income fund and 10% dividend distribution tax in case of equity fund.
Okay.
So there are two reasons why one should go for withdrawal plan than dividend, simply because you can program your withdrawal at a time and quantum of your choosing. Right. Otherwise, it will be dependent on the fund company deciding to give you an annual dividend or a quarterly dividend or whatever be the semi-annual dividend, whatever be the periodicity. You may not need the money then, but you need the money every 2 years maybe. Or so doing that. One is that, the other is quantum. Fund companies can have a dividend which can vary over time, but your needs might be more, predictable, firm, or, very goal specific. So you can plan things better. It's more tax efficient. So always work on a withdrawal plan in case of a mutual fund, and if you hold it for 3 years and more in case of equity, in case of fixed income fund, it becomes extremely tax efficient. You virtually get down to very negligible tax payment on account of capital gains as compared to income being treated subject to a dividend distribution tax or being subject to income tax.
Okay, so this pertains to the equity funds or non-equity funds.
Yeah.
Will your advice change if it is to do with equity fund when it comes to equity funds?
No, my advice on equity fund even before this dividend distribution tax or the capital gains tax was levied on equity fund was that you invest in equity with a minimum time frame of 5 years in mind. Then why go for dividend? Let it accumulate. Equity is an accumulation vehicle. So I'm in fact more, I would be, more, I feel more strongly that equity investment should always have been in growth plan, and now more so because of this tax incidence, because it amounts to getting your money back. Maybe, you get more money back at a more inopportune time, and that is not the goal while investing in equity.
Okay. So what happens to those who are already invested in a dividend plan? What would be your advice for them?
Move your money right away. Move your money to the growth plan and make sure that your investments are over 1 year old. Make sure that if they are over 1 year old, they will not be subject to any exit load. So just be conscious of the exit load and the tax implication of not causing or creating a short term gain for yourself, and that is it. Move your money to the growth plan if you're onto a plan. Dividend plans you should ditch right away.
Okay. So what Dhirendra is saying is that you should ditch the dividend plans and get into the growth plan, even if you are invested as of today in the dividend plan. Moving on to the Q&A part of this program, we take up the first question from Harish, and he says, how are dividends from mutual fund different from monthly interest payout from banks' fixed deposits?
They look the same. You put your money and you get your monthly, a post office MIP. You get a part of your money back in the form of interest. Bank and post office deposits and all other deposits, you earn interest, and interest is subject to income tax. It is treated as your normal income. So there might be some TDS there, withholding tax, but it is subject to, it is added to your income, and you are liable for the tax, the rate in which you fall in. So if you are in the no tax bracket, if all your income is below 5 lakh rupees, are not subject to any tax today, so in that case it becomes tax free. Otherwise you will be in the 10%, 20% or 30% higher tax bracket. So depending on that, it's your income. when you get the dividend in the form of when you get the dividend from a debt mutual fund, it is subject to 29% dividend distribution tax. So when you get 100 rupee in 100 rupees of dividend,
roughly 30
100 rupee dividend, so effectively 29 rupee goes, and you just get 71 rupees. So this is one difference. If you invest in the growth plan of a debt fund and hold it for 3 years, it is subject to long-term capital gains. Even a short-term periodic withdrawal plan, because you are taking a good part of your money, which is getting your capital back, it is not subject to, only the gain component of your investment is liable for short-term capital gains tax. Not short-term capital gains tax, it is added to your income from debt funds. So it's better, it's more tax efficient, and otherwise the nature is the same. Of course, the other big difference, which is very fundamental in the character of the two investments, the deposit as compared to a mutual fund, is that in deposit you exactly know how much you will get. In case of a mutual fund, you don't know exactly how much you will get. It is subject to all kind of market risk, credit risk and everything. But eventually over a period of time you end up getting little more.
Okay. Our next question is from Bhavesh, and he says, how does the fund company calculate dividend payout in mutual funds? Is there a possibility of reduction in NAV after dividend?
Oh, the NAV, the possibility of reduction in NAV after dividend is definite, because it's a very arithmetic adjustment. If the NAV is 100 rupee,
from yours.
Yeah, if the NAV has gone up from 10 rupee to 20 rupee and the company decides to pay a 10% dividend on the face value, which is 1 rupee, the NAV will definitely come down to 19 rupee, no questions about it. How does the company decide to pay, how much dividend to pay and what periodicity? There's a pre-stated dividend declaration policy of a mutual fund. In case of equity fund, most funds actually pay you annual dividend. In case of other debt funds, you can choose one of the plan, either an annual dividend or a quarterly dividend or a semi-annual dividend or a monthly dividend. And there is a stricture on mutual fund that mutual funds can pay dividend only out of the gains that they have created in their investment portfolio. So if the fund company has raised 100 crore, and if it is able to grow that money to 110 crore, then it can, and that too is realized, which means they have done a transaction whereby it should just not be book profit, then only out of these realized gains they can pay the dividend. They can't pay the dividend if a fund company raises 100 crore and you bought the units at 10 rupee. The 10 rupee NAV becomes 11 rupee because the investment portfolio has gone up from 100 crore to 110 crore. But if it is not realized, if they have not sold those units to realize, sold those underlying investments to realize that gain in their books, they cannot pay dividends. So dividends are paid out of the realized gains, and the payout frequency is dependent on the pre-stated policy and the plan that you have chosen.
Rohit has written to us saying that I had invested in the dividend plan of tax saving fund a few years back. The investment has already completed the lock-in period of 3 years. Please advise me, what should I do with that investment now?
It depends. If you need the money, take the money out. It's done with, it's done the basic course. But equity investments are long-term investment. You should not have chosen the dividend plan because, you would have got some small dividend over a period of time, and it would have just, would have been spent, or you may not have done something meaningful. If that dividend, just compare your investment. If you would have done that investment and chosen not to take the dividend periodically, how much the investment would have been. And choosing to get out of this investment or not is entirely a function of you deciding whether it is a good investment. If this tax saving fund remains a good tax saving fund, stay invested.
Okay. Sridhar, we are addressing your question now. What would be the best investment strategy for a person who's going to be retiring in the next 10 years?
Save as much as possible, invest as much as possible, be into equity to the hilt till 2-3 years before you retire. So till you still have 7 years to be substantially into equity, of course taking into account that you have your health insurance, whether you need a term insurance or not, assuming you have built your net worth meaningfully that you don't need a term insurance, have your emergency fund. So having the basic foundations in place, be as much into equity, and 2-3 years before your retirement, plan how much annual income you require and what will be your expectation or what will be your need to derive that from your investment, and plan things accordingly. The basic principle is pretty straightforward. As you get closer to your goal or need your money for consumption or spending, then you need to get into safer asset classes, more stable asset classes. So that part of so maybe on the day you retire, or a year or two before that, the annual income requirement from your investment should have moved into fixed income funds, or fixed income of some kind, or a hierarchy of fixed income investment, something like senior citizen savings scheme up to 15,000, post office MIP maybe up to 10 lakh rupees, 15 lakh rupees in senior citizen savings scheme, or 10 lakh rupees in post office MIP. So that will support you the essential guaranteed income requirement, and then moving your money in a manner that which will support your income requirement, or maybe have 1 and 2 years annual need in a fixed income fund, ignore everything else for sake of simplicity. That will also do well.
Okay. How can one differentiate between a bad or a good investment? And this is being asked by Abani Bhushan.
Oh, that will require many sessions of Investors Hangout to explain all this. But there are two aspects to it. Before deciding on bad or good investment, I think the primary reason why investors actually are disappointed with their investments when they choose an inappropriate investment or unsuited investment. If you choose a great equity fund, and if your need for income or it's for a different purpose, you need your money to grow safely and well for just 2.5 years, the inappropriateness of this investment will disappoint you. Likewise, if you need a great growth investment, and if you have put your money in a great income fund or a fixed income fund, it will disappoint you, because it will not grow into something meaningful. I come across the situations where most people are disappointed with many investments simply because it was inappropriate. And India is and our risk aversion and our inability to reconcile with the equity markets wildness. That is why we have public provident fund investment in public provident fund in India is 2 times bigger than all equity funds and hybrid funds put together. So we are a fixed income country. We are averse to any kind of volatility, and we miss out. It's a huge missed opportunity for Indians simply because it looks safe at the face of it, and it is safe. It has its advantages, but it may not be the appropriate great long-term accumulation vehicle. So first is appropriate and inappropriate. Choose the right vehicle for your right time frame and experience. Then comes good stock, bad stock is pretty straightforward. I think it is all that will require a long discussion. But good companies, they do simple things. You can relate to it. They make profit and they don't do funny things. They don't steal money, and it can all be, but it requires great amount of diligence in terms of ability to look at whether the company is doing something which can grow. It's run by a set of people who are credible enough. And your ability to read a balance sheet or annual report to understand that money is not stolen from the company. Then looking at things that the company makes profit, but there is money in the company which to support that. There is a cash flow to support, because many a times all kind of nasty surprise which we get in the stock market is a result of a situation where company reports a profit but they don't have the money, because you can show profits but you may not be able to realize the sales, or you have situation where you can cook up things report things, and eventually the reality catches up and things go for a spin to your disappointment. So good stock, bad stock. About good equity fund, I would say that a fund which has done well over a full market cycle, 4, 5, 6 years of up market, down market, the fund manager is still there. And a good fund and a bad fund, equity fund, the difference is a good fund actually does little better than the market in a rising market, falls little less. They also fall. A good fund does not necessarily mean it does not fall. And over a full market cycle, it ends up delivering you more return, beats the benchmark by a modest margin, and the fund manager doesn't jump ship. So that's a good investment. Likewise for the fixed income fund, it will be demonstrated in a full market cycle. And right now it has become easier, because in case of fixed income fund, the cycle is longer. So Mr. Risk visits you every few years, and till that time the person who is assuming the greatest risk may not be visible. So now of late, we have come across many credit situations where companies have, fund companies have faced situation where they invested in a bond and that bond defaulted. So today you have a great premise to filter between the boys and the men in fixed income funds.
Okay, so Mr. Risk comes into play in the bank FD. Is it better, or is the debt fund better for NRI investor? And that is a question that's been asked by D.E. Pawar.
Depends. Yes, for NRI there is a small advantage. Many a times the banks pay you higher interest rate for NRIs, for your FCNR accounts or deposits, simply because the government is willing to, or the regulator or the banks are willing to pay you to attract foreign exchange. They're willing to pay you a higher interest rate. So do your comparison. But I would say that both options are for you. For NRIs, there could be a slightly greater advantage, but it entirely depends on your tax jurisdiction and what is the treatment of that income that you derive from the deposit.
Okay. Srikant has asked this question to us. Dhiren, what is in your opinion, investing in banking specific sectoral funds like? Should I continue investing in them?
Ideally, one should not, because if you invest in a multi-cap fund or if you invest in an index fund, assuming you are investing in an index fund, 1/3 of your money is in banking stocks anyway. And while investing, I think diversification is a non-negotiable goal. While investing in a mutual fund, diversification is the goal. You are able to, conveniently, quickly diversify. And the moment you choose to invest in a sector fund, you are saying that I don't want to diversify, I want to invest all my money in this sector. So it violates my core principle of investing, which is it is a compromise on diversification. If it is a supplementary thing to your existing portfolio, it will lead to too much of concentration, because your normal fund will have 1/3 or maybe more or little less exposure to banking stocks anyway. And these have turned out to be extremely, I'm hopeful that, banking sector will do well. A lot of cleaning up has happened in the public sector bank, private sector banks. We have, the big messes. Looks like the regulator has tightened the noose to drive them to behave better. Some of the great banks have turned out to be even bigger and far more rewarding. But I would say that, diversify. Don't violate the basic, you should have your set of principles which should be inviolable, and diversification is at the top of it.
Moving on, should high net worth individuals buy health and life insurance? That is a question that's been asked by Akash.
Health insurance and life insurance is entirely a function of, life insurance maybe not. Because the idea of a life insurance is to take care of your family or your dependents if you're not around. It should not be, and one should look at life insurance as an expense. Expense for buying protection for your family, because your net worth is not good enough or not enough to support your family if you're not around. So if you are a high net worth individual whose financial worth will take care of your family financially, you don't need the life insurance. Health insurance, yes and no, if your family, but I think health insurance, the variability of expenses that can come your way, And also, if you're on to a regular, say, some kind of investment plan, it can disrupt that. So it can prevent you from, that is also buying protection for your family. So not necessarily, but it is good to have it. Of course, it is a must have for anybody who does not have enough accumulation. But for high net worth individual, both are, life insurance you can do completely without it. Health insurance you should have if you're onto an investment plan of, some goal oriented, because it can disrupt that.
Okay. Dhiren, I'm afraid that's all we can take in today's program. Thank you so much.
Thank you
for answering the queries of our listeners.
Thank you.
With the advice that you should ditch the dividend plans and get on to the growth plans. This is Rajesh along with Dhiren saying goodbye to you. Bye for now.